It was one of the largest retailers on Earth, with stores on 5 continents. Its shares traded in Frankfurt and Johannesburg, worth nearly 20 billion euros. It owned brands you might have shopped in, from Europe to America. Then, on a single December evening, its own auditors refused to sign the books.
Within 2 days, roughly $12 billion of value simply vanished. Investigators say the profits had been invented for almost a decade. This is the story of Steinhoff, the biggest corporate fraud in African history. A quick note before we begin.
The story begins far from any scandal, in Germany in 1964. A young man named Bruno Steinhoff started a small furniture business. He bought cheap furniture from Eastern Europe and sold it in the West. It was a simple idea, built on tight margins and hard work. In the 1990s, the company joined forces with a South African firm. It listed on the Johannesburg Stock Exchange and began to grow. At its center was a quiet, intense dealmaker named Markus Jooste. He rose to become chief executive, and he was very, very ambitious. Under Jooste, Steinhoff went on a global shopping spree. It bought the French home retailer Conforama for over $1 billion. It swallowed the Austrian chain Kika-Leiner. It acquired the British discount chain Poundland.
It paid billions for the American giant Mattress Firm.
And it took control of the African retail group Pepkor.
Brand by brand, Steinhoff became the world's second largest furniture retailer.
Tens of thousands of employees, thousands of stores, 5 continents. In 2015, Jooste moved the company's main listing to Frankfurt.
It debuted worth around 19 billion euros.
The largest new listing in Germany that year. Markus Jooste was now a billionaire, celebrated as a genius of finance. He collected mansions, fine wine, and a stable of champion racehorses. To the markets, Steinhoff was a triumph. But behind the glass and the green numbers, something was deeply wrong.
A hole in the accounts that had been growing, quietly, for years.
To see the trick, you have to understand one simple premise. A company's profits are supposed to come from real sales to real customers. Investors trust those numbers when they buy the shares.
At Steinhoff, investigators say a large part of those profits were a fiction.
The problem was simple. Many of its businesses were losing money, and a falling profit would have crashed the share price.
So according to the forensic investigation, the losses were hidden.
Here is how the machine allegedly worked. High up in the group sat a web of holding companies. Steinhoff did deals with outside firms that looked completely independent.
But investigators say those firms were linked to people close to management.
On paper, these deals generated enormous income.
Income that had no real business behind it.
This invented profit was created at the top of the group. Then it was pushed down into the businesses that were actually failing. Investigators call them contributions.
A loss-making store would suddenly receive a mysterious boost to its profits. Bad numbers, quietly painted over with good ones.
And when the auditors asked for proof, the documents appeared. Contracts, legal opinions, all neat and official.
But investigators found many had been written after the fact, created to explain deals that had already been booked, and then backdated.
Year after year, the gap between the real and the fake kept widening. By the end, the fictitious income would total an astonishing figure.
More than 6.5 billion euros. Roughly $7.4 billion US dollars conjured out of thin air.
A lie this big needs everyone to keep looking away. For years, the markets did exactly that. But not everyone was convinced. Questions had been circulating about Steinhoff's complicated accounts. In Germany, prosecutors had begun looking into the company. Then, in late 2017, the auditors drew a line. Steinhoff's accountants asked for hard evidence behind several deals. What they got back, they said, were mostly verbal explanations.
In late November, They delivered a chilling warning. Some of these transactions, they said, lacked economic substance. In plain language, the deals weren't real, and so the auditors refused to sign off the year's accounts. For a company this size, that was a death sentence.
On the 5th of December 2017, Steinhoff faced the truth.
It announced that there were accounting irregularities.
Irregularities that needed an urgent, independent investigation. And in the same breath, it dropped a bombshell.
Markus Jooste had resigned, with immediate effect. The celebrated genius simply walked out the door.
The next morning, the markets opened, and the panic began.
That same day, a short-selling firm called Viceroy struck.
It published a 37-page report. It laid out in detail how Steinhoff allegedly used hidden entities
to bury its losses and inflate its earnings. The share price went into freefall. In 2 days, the stock fell from about 46 Rand to 10, a collapse of roughly 85%.
Credit agencies slashed the company's debt to junk.
Around $12 billion of value was wiped out. A 50-year-old empire gutted in 48 hours.
The damage spread far beyond one company. At the top sat the chairman, Christo Wiese. He was one of South Africa's richest men and its biggest shareholder.
In a matter of weeks, his net worth fell by over $3 billion.
He briefly tried to steady the ship as acting chief executive.
Then he, too, resigned from the board.
But the cruelest losses fell on people who never sat in any boardroom.
Pension funds across South Africa had poured savings into Steinhoff. Teachers, police officers, ordinary government workers. Their retirement money was tied to a share that had just imploded. A public pension manager alone reported billions of rand in losses. People who had never heard of holding companies paid the price.
Now came the hard question. Who would be held responsible? The auditing firm PwC was brought in to dig through the wreckage. Its forensic team spent over a year tracing the deals.
Their conclusion, released in 2019, was damning. A small group of executives and outsiders they found had built the scheme.
Fictitious and irregular transactions, stretching back to 2009. But proving it in a criminal court would take years, and the man at the center kept his silence. Markus Jooste denied wrongdoing and largely stayed out of public view. For years, the case ground slowly through investigators' hands. Then, in March 2024, the walls finally closed in. South Africa's financial regulator announced its findings.
It fined Markus Jooste 475 million rand, the largest fine it had ever imposed on a single person. It found he had willfully published false and misleading information.
And the criminal authorities were ready to move at last. Jooste was ordered to present himself to police in Pretoria.
He never appeared. On the 21st of March, 2024, the story reached its grim end. Near his coastal home in Hermanus, Markus Jooste took his own life. He was 63 years old. He died before he could ever answer the charges in a court of law. For his victims, there would be no confrontation and no confession.
But the courts were not finished with everyone. Months later, the former chief financial officer faced a judge.
Ben la Grange pleaded guilty to fraud.
He admitted helping to manipulate the company's financial statements.
In October 2024, he was sentenced to 10 years in prison.
5 of those years suspended in exchange for his cooperation.
He became the most senior Steinhoff executive to be jailed.
As for Steinhoff itself, it survived only by the thinnest of margins.
Crushing debt was restructured, but shareholders were almost wiped out. The famous name was wound down and faded from the market.
So what does the Steinhoff scandal really teach us? It was not a robbery with a getaway car.
It was a fraud built from contracts, opinions, and confident smiles.
A company can look like a global success on the surface, while its profits are quietly painted on, year after year.
The warning signs were there. Accounts too complex to follow. Deals with companies that seemed strangely close to the people in charge. When a structure is too tangled to understand, that is the warning. Real value is simple. Illusions need complexity to survive. Steinhoff built an empire on a beautifully painted door. And when someone finally opened it, there was nothing behind it at all.
On the fraud terrain, we follow the money, and we expose the fraud. If this story gripped you, subscribe, and tell us which case we should uncover next.